Well, first of all, I just want to say, really excited to be here, honored to be doing this with you guys. You're two visionaries in the DeFi space, and you're really both on the forefront of transforming global finance as we know it. So maybe we could just jump right in, and each of you just introduce yourselves, talk a little bit about what you're building and how it's currently impacting DeFi.
Sergey, you want to go first?
Yeah, sure. We make something called decentralized Oracle network called Chainlink. Chainlink provides data onto layer 1 blockchains like Ethereum and others to enable great applications like DMM, which is what Greg works on. Our goal is to provide the data and the external proof about what's going on in the world, to provide definitive truth about what's happening out in the world in a way that it can trigger a market in a blockchain. So it can trigger an event in a blockchain. It can be used to meet the high requirements of the types of things that DMM is building for the tamper-proofness and reliability that they need to make true smart contracts. And we call them universally connected smart contracts. So that's what we enable.
Yeah, so DMM, I'm Greg Keough, and I'm one of the members of the DMM Foundation. And so the DeFi Money Market, or DMM as we call it, is basically just trying to reintroduce kind of stable interest into the world, right? So this has kind of disappeared globally, right? It's very difficult to get any yield on any type of investment. And the way we're doing it is doing it by combining kind of some blockchain with real world assets, and Chainlink and what Sergey and those guys do is an integral part of it, in basically allowing anybody right now with USDC, DAI, ETH, and we have a vote on USDT to be added, to earn 6.25% stable, kind of uncorrelated interest. And all of this is backed up by real world assets that are producing income, and they're all viewable on chain, as well as many other data points thanks to Chainlink and the technology. So we're kind of one part of the ecosystem for those looking to generate yield, but generate yield in kind of a different way by using, kind of bridging these two worlds between real world assets and the blockchain.
Yeah, and you both, by the way, just got plugs from the previous panel. So everyone's excited to hear a little bit more about what you guys are doing. How would you describe the current state of decentralized finance now?
I mean, I think it's early days. You basically have some of the initial beginnings of financial products, synthetics, things related to lending, interest generating things. So I think it's early, and there's a lot more to do and a lot further to go in both the complexity of the products, the many things they can do. I think there are some exciting things around already coming into existence. And I think the global nature of it is truly a huge benefit, because there are many markets and many people all over the world that have access to the internet, but don't have access to, as Greg mentioned, interest-bearing financial products or any number of other things. So the market is really the global market, and then what percentage of that market then has private keys that can utilize these systems through some store of value that private key controls. But I think that you are seeing more and more value flow into the private keys that hold tokens. You are seeing more and more addresses, you basically are seeing more and more value flow into the format that DeFi can use. You're seeing that happen globally. And then I think that drives the demand for DeFi and eventually leads to more advanced, better and better products, just like, happens in capitalism, generally speaking. And but right now I think it's early on both the product, and it's early on the amount of capital in the space able to use the products, which are both very good things, because I really think the numbers that we have now are like very exciting to people, but really they're a very small fraction of both the global numbers and even a fraction of the larger crypto space's value that could be put into DeFi. So on both counts, I think we're very early.
Well, so would you say first inning?
Yeah.
What do you think?
Yeah, I would concur. I mean, I think we may be either first inning or we're still driving to the ballpark. Maybe we're inside buying a hot dog and beer. I don't know. But it's pretty early. And it does remind me a lot of when I was involved in the internet very, very early on in the late 80s. And obviously the impacts there were pretty large. I think actually the impacts here from DeFi and this technology is going to be much larger. We're at the very, very early phases, which is incredibly exciting. So you have people like Chainlink kind of building the underlying infrastructure, what's going to generate a whole new world and a better way of doing things. This is now visible to some people, but it's still a very small fraction of the people, I believe, can actually see what's going to occur. So we're still very early on the adoption slope. I do think there's a very compelling, however, macroeconomic reasons that this is going to accelerate growth going into the future because, and again, just look at the DMM product, it's based on yield. If you go to, most of the bonds, there's tons of negative yielding bonds. A regular person, if he puts interest or money into an account, earns almost nothing, and sometimes he loses money. So there's all these very compelling reasons to start to develop, to adopt simply an improved infrastructure based on these kind of initial technology elements that we're laying out right now. So it's very, very early, but I think the growth we're going to see in the future is going to be exponential. And I think that people are probably greatly underestimating, I believe, what this change is going to bring and the size of this market. I think it's going to be very, very large. I think it's the new financial system, basically.
Yeah, I agree. So let's talk a little bit about that and just kind of the future of decentralized finance and how you see it evolving.
Yeah, so I mean, I guess I'll take that one first. So I think, again, we're early on, and I think we're going to have lots of different unique products or building specialities, right? So I can speak mostly to the one we're trying to do, in that there's a tremendous amount of assets, globally that produce yield. But if you look at our current system, we have two fundamental problems, I believe, with the economy that at least at DMM and DMM Foundation we're trying to fix. So the first is we have general debasement of fiat currency globally. And I don't think there's any fiat currency that is, and I think that is immune to that. And I think the basic reason is it kind of doesn't, running these systems actually have no real true vested interest in making sure that they're kind of viable and that they're actually accretive in value, et cetera. So that's one part of the problem. Bitcoin and other things, there's many things helping solve this problem. And then the secondary problem is that of lack of yield, in my opinion. So if you look at like financial inclusion, I actually spent a lot of time prior to this. I was the CEO of a joint venture between MasterCard and Telefonica, trying to bring people into the financial system using telephones. But if you look at those two problems, and they're global problems, if the money I earn actually every day is worth less and less, and then the little money I have, I can put somewhere to try to make savings, and I earn nothing, that is actually a tremendous global economic problem. And I think that is, and it's basically pigeonholing people into, even though they're working very, very hard, not getting the ability to kind of build out and prosper. And I think this is what we're trying to solve, a lot of others trying to solve, by building this better financial infrastructure. And I think it's a crucial thing that we need to solve, both for ourselves as well as the future generations, because it's simply it's a better way to do it.
I agree. Sergey?
Yeah. I think that's a very compelling and point of view and worthwhile endeavor that all of the people in the DeFi space are helping move forward in their way, and Greg and DMM are taking a very active role in that. I think that I think the points that Greg mentioned are really two of the main points, and then there are a few others about specifically how the DeFi industry will evolve on the back of those types of dynamics. I think there are serious issues with the global financial system. So I think the way that DeFi gets adopted is through three dynamics. Either you have the crypto community grow and you have DeFi get adopted through that smaller community that's now growing as more value flows into cryptocurrency formatted stores of value. And that's like the slow roll kind of variant of you slowly have the growth of the cryptocurrency community, the token ownership community, and that creates a market that has value which wants to earn interest or wants to participate in synthetic contracts or future contracts. And there needs to be, the existing financial system can't serve those contracts to those token holders, right? So that's what DeFi is fundamentally doing now, to the tune of 4 billion, which is once again a very, very small fraction of what I think it'll be. Then you have a second variant where you start to see fintechs fintechs and insurtechs and technology companies try to come in. And I think that they can use the building blocks that people like Greg built. So I think there's like layers of building blocks. There's the infrastructure layer of building blocks where you have layer one systems that hold the contract state. Then you have systems that are above the layer ones, either for scalability or in our case, data delivery and validation of external events. And both the layer ones and all the infrastructure on top of them to enable other protocols like DMM to function properly, they're getting kind of built. And then you have things like DMM that all kinds of fintechs, insurtechs, other people can collaborate with as a product, as something that people can utilize, as something they can source usage into, right? Because those fintechs, insurtechs, those companies, they excel at getting customers, right? So they excel at user experience, mobile apps. They're unbelievably good at it from the internet boom, right? Of how do I make the best possible interface with the most optimized button color, and the edges of the A/B testing, the buttons, crazy degrees of people have literally degrees in how to make these buttons, right? It's quite advanced. And then you eventually arrive at a third wave of adoption, which is the institutions that have amounts that are not manageable in today's terms, right? So you essentially have three categories. You have the crypto users who are a large enough category now to make people successful, to make DMM successful, to make other DeFi applications successful. 3 years ago, that wasn't the case. 3 years ago, you would have built some kind of DeFi application. You wouldn't have had a large enough user base with enough value stored in private keys that could utilize that DeFi application such that you could say, I have 500 million, I have 100 million, I have $1 billion in my application, I'm successful, right? And that success breeds more people to do that. And it also accrues more and more resources to things like DMM, to the people that are able to successfully aggregate that value, right? The second dynamic is then, in my opinion, when the fintechs and insurtechs try to come into this space, it's going to be difficult for them to do that because they're not going to be crypto enabled or crypto native. They're going to look at it as an add-on, or they're not going to have the it's going to be very difficult for them to remove their existing infrastructure and replace it with blockchains, at least for some time. What they will be able to do is they might be able to add incremental immense amounts of decentralization. So you'll see fintechs and insurtechs being able to use blockchains for payment systems. You'll see them being able to use blockchains for a lending product that gives them interest of some kind. You'll be able to see them, like in our case, they use us sometimes now more and more for data delivery. So you'll see fintechs and insurtechs getting validated data or definitive truth about something that's triggering their system. So you'll see them using decentralized systems more and more, but what they're going to continue to excel at is owning user relationships and driving users into certain funnels of usage of infrastructure and underlying systems, which is what I feel that a lot of the DeFi protocols and the DeFi protocols now, that's what they want to be. They want to be some kind of underlying infrastructure. They want to be an open source standard that other people can build funnels of usage into, because building funnels of usage is one category of competence, whereas building the place that actually executes the contract is a different segregated piece of competence. Whereas before that was slapped together in a single web firm, because the web firm had to generate the interest, generate the contract, generate all the contractual guarantees and the interface. But now you can have a highly reliable infrastructure on the layer, on the base layer, on the Oracle layer, and also on the financial contracts layer. And then people can drive all kinds of usage into it. And then eventually the driving of that usage will extend to enterprises. And the enterprises will then eventually, you already see this from people like Fidelity. You see them looking at how to put any number of crypto assets in the hands of their users. Fidelity's, man, I don't even remember, 3.2 trillion, 6.8 trillion, depending who you talk to. It's a lot of assets. It's a lot of usage. And I think that once there's some first movers that do that in the enterprise, then the other enterprises, they like to very smartly be what they call fast followers for that's their approach, but that's fine. In any case, I think that's the way it's going to evolve. And all along the way, what the infrastructure at the layer 1 level, at the data level, is going to need to do is it's going to need to enable the financial contracts layer that people like DMM are building to keep up with demand. We're going to have to enable them to be able to generate the financial products at the level of scalability, privacy, data quality, and in all the many exciting variations that that users will want to consume. And so that's really the infrastructure's role. The infrastructure's role is to make sure that the financial contracts layer can properly generate and secure, and very importantly, also maintain the security and tamper-proofness of many exciting variants that then the existing internet's kind of interfaces can funnel usage into. And that's the thing that I think people don't fully understand about the future, is they think that there is some kind of interface that's going to just own things. That interface is going to funnel usage and money to the financial contracts that provide the best return and the best security and the best exposure to various risks that they can. That's all they actually need to do for their users to win those users. They don't need to generate the financial contracts.
And I think you see the beginning of what Sergey's talking about right here, right? So you can always see like the little beginnings of this. So so if there's no yield in the world, I know Draper just launched something, Return Network, and it's a pretty simple idea. It's doing exactly what Sergey said, is that you have users who may or may not be that familiar. So let's develop an app that's just a really simple way to generate 6.25% interest, and they're using the DMM protocol as the vehicle to do that. So that's, again, that's what I envision happening as well. You can start to see small bits of it happening. So that Return Network is just one of those. But there's many other people who are using protocols like DMM and others to say, hey, I can build kind of good consumer-facing products using these protocols that actually have very strong competitive differentiation against the other products in the market. And it's not just price. It can be transparency, right? So like in DMM's case, using Sergey and Chainlink's technology, all of the assets are viewable on chain through their oracles, right? If you were to buy a traditional financial product, you would never see that level of detail ever. And we're kind of just at the beginning of doing this. And as we add new asset classes in, so we're adding aviation, and we're working with the oracles right now with Sergey and his team to build those out. You get these great, kind of what we're about at DMM is how do we build like 3 or 4 really good use cases so people can see it, touch it, see if they like it. If you don't like it, try it, interact with it. And then from there, we kind of go to the second phase of what Sergey was talking about is the DMM Foundation. Basically, DMM is governed by a DAO, the DMM DAO. And so if you are a DMG holder, you have governance rights. So, and this is where, depending on level of percentage you have in DMG ownership, you can actually be an asset introducer in different countries. And so you need a certain percentage actually to introduce assets in the country, because again, at the basis, I always come back to is you need something at risk, right? So if we were all sitting, just the 3 of us running the financial system, and we had a lot of equity in it, it would not be in our best interest to debase it, right? We wouldn't want to do that ever. We'd actually want to take the opposite approach. And so DMM and the DMG is looking to do that. And part of what we're doing, again, because DMM at the end of the day, our product produces 6.25% for users, but it's always has 3 key components for it to be introduced into the ecosystem. 1, it has to have a real world asset behind it that has a first lien senior secured position. What that basically means very simply is if something goes wrong, you can get the asset. And then secondarily, it's always over collateralized in 2 ways. So it's either over collateralized in value. So if it's worth $100, you would enter it into the system. It has to be over collateralized, so less. And then secondarily, the income streams are over collateralized. And this is where the DMG comes in. So while we have 6.25%, we actually have extra income that goes to DMG holders, and they actually vote. And so we're actually going to have a vote coming up to that excess income to burn tokens using that. So this is the idea there. I believe if you give control over to people and they have something at risk and they're invested in the system, you can actually build something that is kind of the opposite of the current financial system we have, which is actually something that's growing, that's stable, that's controlled in quantity, that the people governing think like, hey, I want this thing to be the most valuable possible. And by turning these keys over to the community, I believe that they make good decisions. I think, unfortunately, the way the system is structured right now, nobody really has a specific interest in making sure that it's a good system, right? Everybody's in there for such a short period of time. They have a very short, narrow view that they kind of don't care. I mean, for my 4 years or 8 years or whatever it is, and I don't have this kind of vested ongoing interest. And I think by blockchain allows us to do that for the first time, which I think is an incredibly powerful tool.
Well, you're looking at the opportunity too to create far superior products, because if you're looking at, a 6.25% yield, and you're looking at a product that has greater transparency, and why would anyone go to a traditional money market? I mean, it just makes no sense once this really achieves mainstream adoption and people really start to understand what's happening. Which
I think that's. I was just going to mention. I think you're correct, and that's where we get, like, right now we're in the crypto adoption phase. But certainly, this is extremely compelling. There's many more reasons, but this is certainly one of the use cases that's very compelling for normal people if they get the right this new way of doing things. And I think that's going to be very, very large once it starts getting going.
Yeah, no, I completely agree. And, talk a little bit about the just mainstream adoption. One of the things I'm really focused on right now is I'm working on a paper on how fintech is going to save America's fractured retirement system. And, part of it, if you look at, we really are facing a looming retirement crisis in this country, and I think perhaps in many countries too. I mean, we saw a lot of significant flaws with pensions and that whole defined benefit system, and pensions, state, local, are underfunded in a large part because no one ever expected interest rates to be this low and for this long. And, we're seeing, individual retirement accounts that are just severely lacking any kind of access whatsoever to yield. So I think it's really interesting what you guys are putting together, because I think that this could ultimately be a viable solution to Americans' retirement challenges, which is huge. I mean, what do you think about that?
You want to take it, Sergey? I'll follow up.
Sure. I don't want to comment on what will or won't happen with people's pensions. That's a really, really sensitive topic. Because it's very serious. I think that the thing that I would imagine that financial institutions would eventually see is that either they slowly see the benefits of these tamper-proof, highly transparent, well-collateralized assets that have low counterparty risk, because you have blockchains and oracles proving to them that those assets are there and that those assets are solvent. And this will create what I call a math-based guarantee. So it'll create a guarantee on the basis of mathematical proof, data, direct one-to-one kind of data sources proving that the solar panel field that generates the revenue for your asset-backed security, or the aviation-related revenue flows, or whatever other revenue flows there might be, are not passing through a bank that could be insolvent, or through some other institution whose solvency might negate your ownership of an asset or your relationship with a certain flow of revenue. And that's called counterparty risk. And I think at the end of the day that you will either see institutions slowly come to the realization that their counterparty risk in the traditional financial system is unacceptable. I think that there is a very scary and painful scenario that we are moving towards now with the global financial system, where that could all happen rapidly. So if that happens rapidly, two things happen. I mean, the first things happen is that there's a lot of pain out in the world, because there's a lot of people that depend on the financial system functioning properly. And so that's not something that anybody should take, that's not a good thing. That's a lot of people are going to have issues. The one good thing for crypto will be that it will force a realization of the actual, what I call brand-based guarantees that exist in contracts. And these brand-based guarantees are different from the math-based guarantees in that you basically have a logo on a big building somewhere, or traditionally, you know, the nicest building in the gold town. In the gold town would be the bank and then the church. Once capitalism really started taking off, because people cared more about, you know, their money than other things, and they needed, the bank would have these huge pillars, and it would look like the safest, most beautiful building. And the church was now a wooden building, and so that, you know, there's a whole historical transition there. But the nuance here is that I think these brand-based guarantees, if enough of them fail simultaneously, people need to they need to seek guarantees about their ownership, their financial interests, their financial returns. And I think that the place that they will either slowly or possibly very rapidly gravitate towards are math-based contracts in the form of these blockchains, because blockchains are the strongest math-based guarantee of your ownership, your relationship to an interest-bearing product, your relationship to any kind of financial guarantee from between you and some pool of assets. And people don't think about that now because it isn't screwing them yet. If you look at countries that have real problems or have had real financial problems, like Greece, when Greece's ATMs got locked up and you saw people only being able to withdraw 66 euros per day, regardless if they're a person or a business, you saw wallet registration numbers for Greek IPs go through the roof. But you also saw adjacent countries like Spain and others that were worried about their solvency as a nation. You saw the wallet registration numbers in those countries go 600% higher. And so I think that there is a dynamic where people will care more about the math-based guarantees these contracts can give them, but they will really, really care if they realize the brand-based guarantees that they actually have. And I think the unfortunate reality is maybe the only way that enough people are going to realize that quickly enough is if they fail. And that's both going to be quite scary, but it's also going to drive the adoption of this technology very heavily, in my opinion.
And I think to add on to that, I think the other factor that's important to note is that generally in developed countries, they haven't faced these issues previously. So it's kind of hard for people to wrap their minds around that this could potentially occur. I spent 10 years in Latin America, and it happened, you know, in Argentina, it happened every 5 or 6 years, right? And so people are very accustomed to that. But you're correct. You see these numbers spike because consumers at the end of the day are very, very smart. And I think that this is an improved way of seeing and doing things. I think in the developed economies, you haven't had to really deal with this. It's been a problem, but it hasn't been this kind of catastrophic problem. So I concur. I hope it doesn't occur, but if it does, it'll push mass adoption. And then the other layer I'd just put on top of that is there's an undergoing trend in just money and investment in general of millennials. Millennials are actually going to have the most investment funds to invest than any other group. And if you look at them, they're much more interested in, you know, crypto and digital assets than traditionally, you know, a share of Ford. They're not interested in that. And I think this is the second part or second component. I think you have the macro problem, but then you have actually the consumer demand side of it, that they just don't want these products the way they were before. Digital assets have so many different benefits that are far superior. So when you're a digital native, having grown up with it, it makes much more sense that you prefer to have digital assets. And I think a lot of the traditional financial institutions are greatly underestimating the kind of consumer side of this, that the new consumers are going to be the bulk of this, you know, these investments and revenues in the future, actually don't want the current products that are designed. They want new ones. And I think blockchain will be the basis for developing this.
And it's true, and you looking at younger generations also trust technology far more than they trust these traditional financial institutions. So let's just jump into the last question, because I know we only have about a minute or two left, but what do you see is the importance of the blockchain infrastructure, and how does it affect the adoption? Sergey, if you want to start.
So,
yeah, I mean, I think the critical point here is that smart contracts are built using two components in the case of the types we're discussing. They have a blockchain, which is a layer 1 system where the contract state lives, and then they have an off-chain component, which is this thing called an oracle. And the oracle has to properly validate all the data to the degree that it can reliably trigger the contract. And if that data isn't validated, then the contract isn't tamper-proof, and it starts to fall back into the world of traditional centralized financial products and doesn't meet the high standards that smart contracts need to meet. So I think the nuance there is that it's not a coincidence that DeFi is growing as you're seeing more and more data than ever in history being put on blockchains about markets. What we actually see is that as we put more and more data on chain, our users and even new users are able to either launch new markets for existing products as we make that data available. Because you can't actually build many of these you can't build any of them without data. So the products you can build in this DeFi kind of revolution problem space and this category of products is completely bounded to the data they have access to. And that data needs to be validated in a specific Oracle mechanism manner. And it is that manner that we excel at. And that's why we work with a lot of these leading DeFi teams, because we are enabling them to launch not only more products, but to launch entirely new categories of assets onto the blockchain, because the contract can now have data about what's going on with that asset.
Yeah, and I see when we first started working with Sergey and the team there, and this is some time ago, I mean, it's an essential component of what we're doing by combining the real world assets with the digital world. They can't work without actually the oracles. And we're actually at the very beginning phases of using Chainlink in these oracles. There's many more things we can do as far as not just on, the data reference networks we're using. We use them for the collateralization ratio. And by having, as Sergey says, these smart contracts attesting to and making sure that valuations stay on track, and if not, immediate actions take place that you couldn't, for example, issue more tokens, right? If it's not, the ratios aren't correct. This provides this kind of underlying security and data integrity that's essential to building these new products, these new financial products. And there's just many other components. I mean, if you look at like what happens if the Oracle comes back and says, hey, a specific lien on an asset is not correct. Well, it can take immediate action to stop any further, as I say, issuance of tokens and many other automated responses, so that the ecosystem, people, invested in the ecosystem, know that there are these guardrails you can't get out of. And so it really, using Chainlink and these oracles, prevents kind of crises like the mortgage crisis, right? If all this stuff was on chain and it was viewable, you wouldn't have had any of those problems. And that was a big problem. I mean, it almost took down the world economy. And so this is where I think it's just so tremendous. It's so much more beneficial to end consumers that it is inevitable, the end adoption of this. And obviously the macro and other factors are just gravy on top of that. But the end state will definitely be this.
Plus, I'll just add too, the ability to create all of these new asset classes and new investable products, it's really creating a new universe or new unprecedented ability for diversification. And once we have that, then it's, individuals, their ability to mitigate risk and enhance their returns, it's unprecedented. We've never had this before. So it's really incredible what you guys are doing. And I think that's all the time we have, but thank you very much. This was really, really informative. Really appreciate it.
Thanks, Dara.
Thank you. Have a great day. Bye.
Thanks.
Bye, guys.
Bye.